So selective, what do you look at? I mean, what's the playbook for the second half of the year?
Yeah, I do think the first half, if we look back at the market, when we talk about last time in this studio, is you can really get a front seat with the AI boom by investing in Asia at a discounted valuation as compared to investing in the developed markets. But here we are, we bought the ticket, we are on the ship. I do think the ride will be a bit more turbulent from this point on. The first half is a lot of momentum driven. The AI tide pretty much lifted all boats. The second half for stock pickers myself is really about who is going to maintain that level of profitability as capacity expand, and maybe there will be demand volatility as well.
So who will
AI.
maintain that level of profitability?
So I think it's a great question. So what we are doing in the fund is really expand from just looking at the memory cycle to more broad-based components, such as MLCC makers. They are the passive component makers. They have done amazingly well in terms of share price, but I do think the operating margin for these guys still have room to increase as they raise their product prices. And on top of that, we do think the ODMs, i.e. The likes of Hyde, Foxconn, they are really putting the server racks together. They will start to deliver more of the Vera Rubin racks in the second half that could potentially lift their margin, their profitability, and generating decent return on earnings to shareholders.
So Fiona, on the debate on the memory cycle, which part of the cycle do you think we're in?
I do think, at the beginning of, if we take a step back, look at what happened to the memory capex over the past few years, because we have been through a really tough period of profitability for the likes of SK Hynix, Samsung Electronics, as well as Kioxia. So rolling 2 years back, they were under investing in future capex. And looking at 2026, because of agentic AI, the demand for NAND, for DRAM has just accelerated at a pace that no one really expected this to happen. So that supply and demand dynamics has resulted in this surge in memory prices. And where we go from this point is really, you look at the supply, every player is talking about they're going to increase capex, including in Singapore, Micron going to build a mega sort of manufacturing hub. So I do think capacity will catch up, and on the demand side, it will remain strong, but as capacity catch up, that pricing may not be as high as what we are seeing today when we are really in this tight bottleneck.
The narrative, though, has been going on for quite a while, right? What you speak of. What is it going to take to carry things through in the second half?
Actually, if you look at the supply analysis, at the beginning of the year, people expect about mid-teen supply growth from all these memory suppliers, but here we are. Most analysts are expecting about mid-20s supply growth. Actually, that supply is already coming, and going into 2027 as some of the clean rooms get filled with more equipment, as well as even new clean rooms get built by this mega capex being announced by the memory makers. So we do think, as customers paying for such expensive memory for an extended period of time, they might take a pause and think about how much inventory do I need? Is the price going to decline? If there's expectation price going to decline in, say, second half of 2027, even 2028, they might just slow down the pace of building the inventory and just ease off that pricing hike that we are seeing at this moment.
In terms of the path for chip makers, how much more upside is there? Second quarter, 88% gain. Choppy third quarter, at least for the start. Are you expecting the same kind of pace or a slight pullback?
I think the volatility in the market is caused by both the fundamental as well as the technical issues. If we look at the market participation in particularly the memory space, there's a lot of double leverage, triple leverage ETF. So that just exacerbates the volatility we see in the market. And some of these ETFs are the best selling products on the planet, the best sold ETF, leverage ETF, single stock leverage ETF for by a mile. So when there's any volatility,
when money is being pulled out.
Exactly. So whenever there is any such as a meta news that just shake a little bit this off, then we're just seeing the technical aspect to create more volatility in the stocks. So I'm definitely more mindful to look at what is the market expectation versus what can be realistically achieved by this company.
Where is Korea? Where is the Korean market in all of this?
I think I do see Korea being more of a broadening out of the current thematic. In the past 12 months, everyone just obsessed with memory. We learned so many new things. I went to a lunch the other day, group lunch, and someone is asking me, "Are you a tech specialist?" Sorry, I'm not. I'm a generalist fund manager.
These days,
yeah,
right?
but then everyone talk about, MSCC, CPO, what do they stand for? Yeah. No one really knows, but they invest into those stocks. So I think in the second half, we will see more of a broadening out of the theme for both institutional investors as well as retail investors, particularly in Korea, as the companies start to pay out massive amount of dividend to shareholders, as well as the massive bonus to their employees. We will see them spending more in the local economy, and as the company's capex ramp up, we're going to see the bank's lending side get acceleration, and also the construction company getting more business to do. That will be just moving one narrative to a broadening out of secondary, tertiary sort of beneficiaries in the Korea market.
Does the capex plan we've heard from South Korea this week still make sense then? If you're talking about 27, 28, there are going to be question marks about inventory.
I think the AI trade is here to stay. The AI demand is here to stay. If you think about, the application of that, not just in the data center, but in the future, in the PC, in the smartphone, you need more and more of these things to really function for the AI applications. But then at the same time, will that be pocket of demand weakness? We're likely to see that. But from the government perspective, from the company's perspective, they can see the demand to rise in the future. They need to invest now rather than wait until 5 years later to thrive.
Do you see also that there maybe is increased impetus on the focus on AI monetization in the back half of this year? And then if so, what sort of early indications will investors be gleaning from?
Yeah, that's definitely one of the biggest concern, or every investor is just so sharply focused on what's the return on AI capex. I think that also explains why Asia, particularly Korea and Taiwan, are the major beneficiary of the trade at this point, because no one knows what's the return on this cloud capex. But what we know right now is Samsung is having a super cycle that enjoys super normal profitability. TSMC is just, there's not enough capacity to go around. They can ask for any price they want, and the customer will probably say yes. That's why the trade has skewed from, in the past you invest in the Max 7 or Nvidia, but now you are actually investing the pick and shovel stocks in Asia. I think that narrative might change, but it might take time, because this AI, the cloud capacity is coming up, and a lot of the players are actually competing on the same commoditized products. What could the potential return be, or what sort of large language model they can attach on top of that basic cloud services that really drives the return on investment for the Max 7 in the US. And I do think with their capital return in mind, that they have just delivered exceptional growth as well as high return on investment in the past, the management of this company are mindful of their investment. If inflation is too high for the hardware, maybe and the return is not decent enough, on the other side, they might start to slow down the pace of construction, not
Fiona,
get away with it.
The other preoccupation in the market is actually Japanese yen, 162 and change, and now some kind of support, but that's to do with the dollar pretty much. I'm just wondering, what's the level you're looking at? Some say 165, and those who are really bearish go as far as 200.
I think the yen, a bit like Korean won, is also a positioning issue, not just a reflection of economic fundamental. If you look similarly in Japan, it actually benefited from similar sort of Korean benefit, a lot of the tourist inbound as well as the tech cycle. So economy is actually doing quite well, but then there is also foreign capital outflow, and a lot of the Japanese companies are actually bringing money overseas to invest in other companies, like in India, the market that I look at, there are just so many Japanese banks trying to invest there. So that has determined the level of currency. But then from what we have seen at the payroll number, it seems there is less pressure for rate hike in the U.S. So that could help.
We
with
heard some
the Japanese yen.
suggestions from Kevin Walsh that there is urgency to actually address the yen weakness. What does that necessarily mean? What action might be taken, you think?
Good question. Something that I'm watching as well, but I wish I could have a crystal ball, could tell you what is in his mind. But then if you look at a U.S. perspective, they just worry about export competitiveness. They want more of the products. They want the reindustrialization of the U.S. economy. So when they talk about that, they just worry, with yen being weak perpetually, that will just prevent some of the manufacturing capability being moved to the U.S.
Talking about manufacturing, in EM Asia, where looks like there's more opportunity now. I mean, we have Malaysian IT stocks, they're making a comeback. But also you have that cyclical narrative in other parts of EM Asia, given how oil is traded. What do you like, aside from AI?
I think manufacturing specifically, I think China still have a lot of room. I think in the past, people talk about China plus and diversification of supply chain. And a lot of the companies that we talk to, eventually they realize China is still the most efficient with a cohort of supply chain companies, and the transportation is just logistics is just amazing and very cheap, so they can manufacture at the lowest cost in China. And also on the other side, on the demand side, right, the tariff is basically being implemented everywhere. China is not necessarily suffering from the highest tariff anymore, so that is less of an incentive for company to move that supply chain out of China. Structurally, it's also robotics could help. If in China, the worry is we don't have more babies there, as a result there will not be enough labor in 10, 20 years time. Now we have robots, and China can probably manufacture robots like EV at a really cheap price. So if you don't want to work in a factory, that's fine. There are robots to work there.
Valuations are also cheap. What do you think is going to take for that mindset shift?
I think we were looking at a lot of manufacturing companies based in China these days. What could take the mindset to change is really they continue to deliver the earnings growth that they have been delivering over the past decade, and they prove to the market, to the consumers, that we have the cheapest products on the planet. Even if you impose massive amount of tariff on us or anti-dumping tariff on these companies, they can still do very well by bringing even their manufacturing plant to the US, which is difficult, but to Europe, that has just proven to be quite successful for the Chinese manufacturers.
And speaking about manufacturing, India wants to get in on the game as well, and India's fortunes are reversing right now.
I think in India, at least from the companies we speak to, is still quite difficult to ramp up your manufacturing there, especially advanced manufacturing, just purely because of the labor force, because of the red tape to get the factory started, as well as the logistic. It's exceptionally expensive to do logistics services in India because of the infrastructure condition that we are seeing now, but it doesn't mean it won't change. I was just in Mumbai last month, and it just changed so much versus the last time I was there. The government is definitely working on that, and hopefully, if say another 3 years or 5 years later, we can see logistic costs to come down very quickly and become a manufacturing hub, not just for the domestic economy, but for the broader region.